When rates get lower, small businesses, which employ 55% of Americans, small business employs 55% of Americans. When they get cheaper money, they borrow and they hire.
Expanding our money supply because the Fed has been restricted. I'm going to explain that.
Credit card loans, car loans, those are short-term borrowing rates, and they are low right now.
Microsoft and Google came out and said, we're not going to reduce our billions of dollars of spending. Existing home sales, 4 million home sales annual rate. That's with a little drop.
Hey, it's KP coming to you live from Charleston, South Carolina. I'm at the ZDI Customer Advisory Board. That's tomorrow. This is just a small group of us. Everybody say hi. We're on LinkedIn. Got some faces in here. That was unplanned. They had no idea. I'm going to tell you why we may be at the bottom of rates. This might be the low points. Do I have your attention? Okay. First of all, happy Rosh Hashanah for those that are celebrating. And, okay, they had no idea I was doing that. I was like off on my own. This is beautiful Charleston. I've never been to Charleston, South Carolina. Apparently on the weekends, this place is packed. About to get hit by a car, per usual. ZDI, our major credit provider, has an advisory board. And we all know how expensive credit is, and they're really helping us with all the services, all the bundling, all the data. They do a lot of stuff. Anyway, okay. So it is the first official day of fall. It is the autumnal equinox. The days are going to get darker from here. Today was 12 hours of light, 12 hours of darkness. The winds of change are sweeping. So let's talk about some changes. Obviously, the Fed is cutting rates or has cut rates and said they want to cut more rates. But it's about labor. So the first Friday of October, October 3rd, is the next big jobs report. And if that's strong, rates will go up. If it's weak, rates will likely go down. And remember, there's the September segment, but then they will also do some revisions to July and August. And so if there is a weakening trend continuing in labor, we could see rates and the 10-year treasury get below 4. We are approaching the Elon Line, 420, and that was the level of support before, and then we pierced through it all the way down to 4%, and then now usually a level of support on the way down pokes through, becomes resistance on the way up. So I wouldn't be surprised if we make our way to 420 to Elon Line. Or as Bill Bodnar puts from Tabrasa, the Snoop Line. But labor is obviously super important. And I think it'll be a little choppy, a little uncertain, because the certainty was brought from the Fed last week. But the certainty was they're uncertain about, the dynamics of balancing labor and inflation. But they're certain that it's labor over inflation. But no one knows if it's going to get stronger or weaker from here. And so when rates get lower, small businesses, which employ 55% of Americans, small business employs 55% of Americans. When they get cheaper money, they borrow and they hire. So they could start hiring, knowing that there's this cheap money flow coming to help them continue. I mean, think about all the refinance activity. It just exploded 50 to 60% month over month. Loan applications locks. Everyone is locking loans like crazy right now. I mean, just again, you guys listen to me because I'm a C-level, I'm a shareholder, I'm an owner of a lender, a 3-channel lender, I have a perspective, it's unique. And so I'm not saying anything here to talk about my company. I'm using that perspective to help us all. We locked $1 billion in locks in August, a little bit more than that. We did $1 billion just to the 18th. So we're up. Everyone's up. We're not unique. We're all riding the wave. Like my deceased father used to say back in 06, 07, he's like, you didn't make the wave, but you look good riding it. And we don't make the rate wave, but we are riding this wave right now. But it's not just refinance activity. It's not just people being brought into affordability for lower rates for purchase money, although it's seasonally the back half of the year, which I contend is the best time to put an offer on a house when there's less competition like in the spring.
But it's not just mortgage rates that are affected. Car loans, credit lines, credit cards, debt, restructuring debt everywhere. And small business may start hiring. I don't know if it's too soon for that to show up, in a labor report on October 3rd. But if you remember a year ago when the Fed cut 50 bips, then we got a strong labor report in October, followed by another couple ones, and inflation kind of uptick. But the labor was the reason rates went up last year. It could be the same reason they go up again right now. I don't know if we're going to hire. Doesn't feel the same this year, but we can't manage by feel. We have to manage by data. That's why the Fed is data dependent. Okay, so real quick, talk about inflation. PCE report, personal consumption expenditure. It's out Friday. It's the Fed's favorite measure of inflation. It's called the Fed deflator. That is less, housing dependent, like the CPI. And we kind of expect what's going to come out later this week, but it's still a market mover. The Fed Chair Powell talked last week about inflation. He said, we're seeing mostly that, the businesses are eating the higher costs. And so I've talked in the past about tariff sneakflation. And I talked about even in my last video, but I'm talking about for months. But we could see some sneakflation of prices come to consumers down the road. But for now, that's not really happening. So consumers aren't really taking the hit. Employers are, or big businesses are. Like I use an example of Walmart, for example. Not that I had any data on Walmart, but these billion-dollar businesses are taking the hit, and consumers aren't as much, and so that's okay. Wage inflation is outpacing inflation, so that's okay. But jobs going to zero income when you lose your job is highly deflationary. Will that trend stop? Will labor reverse? We will see. So it could be the bottom in rates because lower rates could lead to more hiring, which could lead to better jobs reports, which could lead the Fed to say, we're going to pause. Maybe they won't do 2 more rate cuts this year of 25 basis points. I don't know. So we'll see. I'm going to walk down the street. Seems to be no cars here. There is some legislation going on, and I want to call out California AB 1018, Assembly Bill 1018. So it was an AI data bill. Okay, it's very interesting. So state of California, this bill got squashed, right? The California MBA, you guys know I'm on the board, and we have a great team. KP Consulting helps us. The national MBA also jumped in to try and kill this bill, and this bill just got killed. They didn't make it to the floor to a vote this session, and it was supposed to take like our personal information. And if you're a company, let's say you're Fannie Mae or Freddie Mac or Ginnie Mae, and you use a California resident's information, you've got to show how you use that information. How are you using that information? Show us your DU and LP algorithm. You're using our consumers' data to make credit decisions. You need to show us how. That bill got killed. Now, there's some other states like Colorado and a few others around the country where they're leading the charge. So we'll see where all that all goes. But in California, got killed. So that was big. And then in Congress, obviously, we have no budget because it's Rosh Hashanah. Happy Rosh Hashanah again. Congress doesn't meet until next week, and they only have a couple days to fund our government. Will they have a continuing resolution? There's a House bill that passed. The Senate bill has to pass with 60 votes. There's a slim majority for the Republicans, but they don't have a 60-vote majority. So will Senator Chuck Schumer and the Democrats use the leverage of the votes needed to pass a continuing resolution to maybe just kick the can down the road for like a couple months? I mean, we're in fiscal year 26. They're trying to pass a budget for that. We're about to be. And so the Democrats are trying to get some of the rollbacks from one big, beautiful bill on Medicaid and Medicare to be put back into this continuing resolution. I mean, I've heard upwards of $1 trillion in additional funding over the next 10 years. But I don't know if they can work all that out. They only got like 2 days next week after they get back from Rosh Hashanah. The Congress is on break. So we have a potential government shutdown we're trying to avoid, which of course could disrupt the stock market, which is at all-time highs, which is ripping. I'm not a financial advisor. I'm not responsible for your losses, only your profits. But the AI boom is real. It's not going anywhere. It's going to be part of everything we do. Cultural, economic, military. I mean, there's trade, everything. AI is going to be everywhere. We all know that. And today, NVIDIA pledged $100 billion into OpenAI. which makes ChatGPT. So there's a lot going on out there. I don't pretend to know everything that's going on with AI, but I know it's going to be everywhere. It's going to be a base layer like air conditioning, black and white TV, automatic transition, you know, uh, smartphones. Like it's going to be everywhere and part of everything. And it's totally overhyped in the short term, but way underhyped in the long term. So tons of investments. The market's still ripping. I don't think the stock market, trees don't grow to the sky. So, I don't know when that correction or pause or whatever may come into place. I don't know what the impetus will be. But for now, AI, data centers, the growth in energy, there's a lot being swept up in that AI trade. And so far, things seem good, but every market can take a healthy pause. And just like rates took a healthy pause after the Fed announcement, buy on the rumors, sell on the news. What's the next buy on the rumors, sell on the news moment for the stock market? I don't know. We'll get back to you Thursday night. I'm so thankful for Zactus having us here. Incredible data, credit, bundled verification services. They have tons of, like Zactus 360, have so many different products. Check them out. And I will be back home Thursday night. So we'll get back to you. Cheers.
Live from Corona, California. Just got back from Charleston, South Carolina. My first visit, the Zactus Customer Advisory Board. Very good meeting. They had Mark Calabria, who is now at the OMB, the Office of Management of Budget, former director of the FHFA, and I have some insights from that. It's really incredible. But before we get into that, we'll get into some macro stuff, and I can brag on all the other cool things we did at the Zactus Cab. Okay, so rates are ticking up, and people are wondering maybe what's going on. Remember, we had a buy on the rumors, sell on the news moment after the Fed cut, and all the Fed speakers have been coming out and saying, "Hey, we're not really sure what's going on." So it seems like some hawkish comments, coupled with the buy on the rumors, sell on the news moment. It's clearly a labor over inflation market. That does not mean that tomorrow's personal consumption expenditure is unimportant. It's certainly important. There is a dual mandate, even though it's really a tri-mandate, which also includes stable long-term rates, trying to keep the 30-year Treasury yield down. Anyway, PCE is coming out tomorrow. It's the Fed's preferred measure of inflation. It's literally called the Fed deflator. And it's important because it's a snapshot for the month of of August. It's kind of like one of the last data points for the month of August. And here we are at the end of September. And we're just now getting it. But they took time to collect it, so it's fairly accurate. No one really questions the accuracy too much. Now, last month you had a 0.27 increase, which month over month, which is rounded up to 0.3. And tomorrow could be a 0.23 increase. But remember, an index, all indices, takes 12 monthly readings. In August of 24 were actually really low numbers. So we're expecting the overall numbers for both core and headline to go up. So 2.9%, will that be the high number? Will we see a 3? I think it's important to note that if last month was 0.27 and this month is 0.23 or 0.24, possibly, it's going to be looked at as 0.2 this month versus 0.3 last month. So less in the month, even if the headline number goes up. So again, a lot of these things are kind of expected. What was market moving is we've had some pretty strong economic data today. Q2 GDP 3.8%. That's up from the last reading at 3.3%. So the economy is growing in Q2. But, we know that overall, the numbers have been a little in flux with the Q1 data being a negative 0.5 GDP because of all the tariff pull through. With higher for longer rates, it's harder for housing to kind of get kickstarted, which has been in a recession along with manufacturing. If housing could catch a bid, GDP could grow. And so if we're at 3.8%, add maybe another point to that if housing can grow. I thought it was interesting that the trade deficit actually went down. There was a lot less imports in the last trade deficit income. Durable orders, if you exclude all the Boeing equipment, which is a massive number, Boeing is a huge manufacturer, they had a big number. So even excluding the volatile aircraft orders and durable numbers, durable goods report, you still had a pretty good report. So to top it all off, the one labor point we got this week was like 211,000, something like that. 218,000 weekly jobless claims, down from below the consensus of 235,000. You still have about 1.93 million, 1.9 million continuing claims. So not a lot of hiring, not a lot of firing. If you're out of a job, it's harder to find one. And, that's been kind of sticking in that range. So let me go to something I positioned last week after the Fed meeting and on an earlier video. This could have been the low end rates for the year. It's just a hypothetical. And it all depends on labor, of course. Next week is jobs week. We'll get a lot of data coming out regarding employment. Is it still weakening? We're creating less than 30,000, 35,000 jobs a month the last couple months, maybe 25,000. So next Friday, the first fake Friday, the fake Friday jobs report. Although there is a new BLS head in there, so we're going to start saying it's for real at some point. Anyway, the jobs report that comes out is really going to be the determining factor of where interest rates go. I've been talking about the Elon Line. Bill Bodnar Tabrasa calls it the Snoop Line, that 420 line. We haven't quite touched it, but that was kind of the high end of the range. If PC is hot enough tomorrow, it could actually push it, maybe above that range. But I think the market kind of wants to wait until next Friday, but we'll see. I mean, we could go as high as, 425. There's these different technical levels of resistance, but the bottom line is that jobs report next Friday, October 3rd, if it is surprising to the upside, you could see rates go up, just like they did a year ago when you had an October jobs report surprise, which then, of course, we know was a fake Friday report, just like all the fake Friday reports, because the QCEW came out and wiped out like 911,000 jobs. So these Friday jobs numbers that come out and all the other jobs numbers that come out, they're important in the moment. It's all the data we have to work with decades of history, even though it gets cleaned up a little bit later. We have a 4.3% unemployment rate. So we're watching that jobs report and jobs week all next week. If the jobs report is yet again soft for the month of September, and there are more revisions for August and July looking back, we could see rates come back down. So we're all waiting with bated breath. But the flow of money is more than just that. We've had some bond auction, treasury auctions this week. Remember, there's a lot of treasuries being dumped onto the markets. And so, these auctions were average reception, maybe not well. 2-year treasuries, 5-year treasuries, 7-year treasuries. All this supply of money being forced onto the market with a $4 trillion one big beautiful bill and a $5 trillion debt ceiling and good economic news, that's also not bond friendly. So, if there's a lot of treasuries that bond investors have to buy because the Treasury Secretary is, got to fund our government, that, if there's more supply than demand to buy it, then yields will rise. They haven't been rising too crazily. So we'll keep an eye on that. And by the way, the Treasury Secretary can do what Janet Yellen did. Treasury Secretary Scott Bessent can kind of manipulate the numbers when we have our quarterly refunding Treasury announcement, which I can't remember the exact date, but they could start to manipulate the flow and the denominations and how much of 30s and 20s and 10s and 7 5s and 2s that we sell. So quick look over here at my MBS highway chart. The 2-year Treasury is at 3.65. So the 2-year Treasury is the one Treasury yield that really is the mostly correlated with what the market thinks the Fed should do as it relates to cutting the Fed's funds rate, which is an overnight rate, and also where the economy is going. And with a 3.8% GDP, a surprise upside in gross domestic product growth in the economy, the 2-year Treasury went up. It's been below 360 for a couple weeks, and it's at let's just call it 3 5/8 right now. That still is a clear cut for about another 50 basis points. It's a clear sign for another 50 basis points in Fed funds cutting. It's 2 more 25 basis point cuts. Next Fed meeting, just a few days, a little spooky meeting, just a few days before Halloween. So let's go back to the market since we're talking about the flow of money. You may have noticed that we had all-time high after all-time high in the stock market. I am not a financial advisor. I'm not responsible for your losses, only your profits. But, there's also some profit taking that goes on out there. I saw an interesting chart at the beginning of the week about Bank of America's cash index. It's something like 3.6% cash on hand for money managers. That's a low amount. Once it gets past like 3.7 or something like that, it's at Bank of America. It is called a sell signal, where institutional funds have to sell stock, which are at all-time highs, to raise cash. I have, just a little personal information here. I have some money with Keith Nickel over there at Carrera Capital Advisors, and their money fund manager started selling some things at the end of last week. By the way, at all-time highs, great timing. And so, not that they're raising cash for me for any reason, but a lot of times, this flow of money, it is all connected. And so people feel wealthy when the stock market is ripping and they look in their 401ks. And I highly advise everyone to invest in stocks, time in the market, not trying to time the market. Even if it's $100, just get in the market, get in the game. One of my only rule that I told Keith and team at Carrera was never sell NVIDIA. So I have an own it, don't trade it policy. I stole that line from Jim Cramer. I mean, it's up like 2,800%. And I feel like they have such a backlog of orders. The AI move is not going anywhere. And I'll get into that in just a second after the Mark Calabria thing. But I say this because the stock market could sell off. We have, quarterly window dressing. So, when stocks get sold like they do, like last week and this week at all-time highs, it shows these gains and it locks in this cash amount. And a lot of money managers do it around the same time at the end of a quarter, like the end of September before going into Q4. So they can show you how much they made you and how great they're doing, which a lot of them are doing great, obviously, as long as they're in the market. And so that's a big selling effect. It has a net effect of drawing money out of the equities market, the stock market. And so that does matter. Mark Calabria is one of the most approachable guys. I had dinner with him a couple years ago at the ICE Experience, about a year and a half ago. He's held meetings when a lot of us went and advocated in DC for the MBA. And, he's really helping set the tone in housing policy. And, he thinks this government shutdown is gaining momentum. And, he had a lot of things to say about affordability and housing. And it's just a really interesting hour-long conversation on a Zoom call with a group of us in a closed-door meeting. And we talked about the insurance crisis. We talked about, trying to make it easier to build houses. Talked about GSE, reform and re-IPO and raising money. It was a lot. So it's really good that Zactus got us that accessibility to him, and he's just a great operator. He's been in this business a long time. Anyway, let's talk about AI for a hot second. It's not. I read this. I thought it was interesting. AI is not consigned to boosting efficiency in the office or creating artwork on a dime, which a lot of us talk about now. It's becoming the backbone of 21st century power, military, economic, technological, and cultural. It's not slowing down. It's a big deal. And a lot of this capital expenditure by these really large companies, especially the Magnificent Seven of stocks, they're spending a lot of money on AI, and they're building. And it is having a ripple effect. We're obviously seeing AI take hold in our business, and it's only going to get better and stronger and be a base layer and kind of a part of everything. So, you know what? Look out for us on The Last Word tomorrow morning on the Chrisman Commentary, and I'll get back to you on Monday night. 10:45 here. Gosh, it's so hard. My sleep, my 3 hours off, all the things. I'm going to get the heck out of here. Have a wonderful weekend. And by the way, the sell on Rosh Hashanah, buy on Yom Kippur is kind of a long-standing tradition in the stock market as well. Yom Kippur is October 1st through 3rd. So could be timed, obviously, with the seasonal changing, fall, quarterly and window dressing, quad witching, all these things in the market. But a lot of times this is a seasonal period where stock markets sell off and then people start to buy going into Yom Kippur. So thought I'd throw that last little tidbit on you. Have a wonderful weekend. Cheers.
You've been listening to KP Talks Dollars and Cents, a top-rated show for those who want to learn about the economy and mortgage environment. Tune in each week for more episodes, and please leave us a 5-star review on Apple Podcasts and Spotify. Kevin Perenio does not render or offer to render personalized investment or tax advice through KP Talks Dollars and Cents. The information provided is for informational purposes only and does not constitute financial, tax, investment, or legal advice. For more info, follow KP Talks Dollars and Cents on all of our social channels.